Hey everybody, Brent Morse here. Time for Long Options. We do this each Tuesday at this time. Glad you're joining me today. And if you're watching on a recording, we're glad you're here too. Good to see some familiar names in the chat. Glad to have you here and glad to have Connie as well. Connie Hill helping me out in the chat. I've known Connie for many years. She knows all the concepts that I'm going through here. As you have questions, feel free to type those in the chat. And so between Connie and myself, we'll do our best to get you helped out there and get your questions answered. So you can also follow us on X at Brent Moore CS, at Connie Hill CS. We put out some additional content throughout the week there to try and find, just give you some more content, try and help you out. So let's go through the disclosures, then we'll get to the topic at hand. And just remember, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It is not a recommendation or an endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is provided for educational purposes only. I may not factor in commissions or fees in these trades, but keep in mind that is a consideration for you to think about. There's no guarantee of an execution of a stop order that it's going to be at or near the stop price. It could fill at a very different price. Past performance of any security or strategy does not guarantee future results or success. And we'll be looking at individual securities here, individual option trades. These are not recommendations. And there we go. Let's head on over to the markets. Here's the SPX. We're down a little over 0.5 percentage point today. A little pullback, but nothing out of the ordinary. In fact, to be honest, I think a lot of people would look at the market, and at this point, we hit the high, all-time high. I think a lot of people would have expected a pullback at that point because look what the market does. It goes up and it pulls back, up, pulls back or sideways, up, back. It's just that's the path it's done. And so most stocks, if you look at most stocks in the market, they're going up overall. I mean, the SPX isn't indicative of all the stocks out there, but it's a broad-based index that people look at. And so you'll probably find more bullish examples right now if you're following the trend than bearish examples. But of course, the past trend doesn't guarantee the future. But as you're doing trades, there's a lot of different choices you have when you make options trades. Today, specifically, we're talking about long options, long calls, long puts. But even with long calls, long puts, you can choose different expiration dates. You can choose different strike prices. You can choose which stocks you're going to do the trade on, and whether to do the trade or not, when to get in, when to get out, that sort of stuff. But one pretty fundamental decision that you make that is going to come up over and over again is strike price. What strike price do you do if you're doing an option? And so we'll talk about that. We're going to give you some examples, but I want to also talk about kind of not just specific examples. I want to talk about a generalization too, so you can use it for any example, anything you look at in the future. And so I want to talk about the process of looking in the money, at the money, out of the money. Which contracts should you do? And I'll give you the quick answer. The answer is it depends. And the answer is it's not all good or all bad about all of them. There are options, they all have their risks, but there's just pros and cons and trade-offs as you do these. So I want to look at that. I'm going to go to the trade tab here as we do this. And actually, before I go to the trade tab, let's do this. Let's look at a stock. Let's look at Lam Research here. Okay, so what I'm going to say here on this is, let's say we're looking at a call option. Okay, let's say we're looking at a call option, and we're looking for this to bounce up, maybe up towards here. Okay, the stock's up, the high was about 108. Right now, we're at about almost 100. That's roughly an 8% move up. Let's say that were kind of a target area for us, about an 8% move up. okay? And so, great. We decide we're going to do a call option on this or something. What strike price should we choose? Well, of course, the expiration date, it just, you want to buy enough time. I wouldn't want to buy a 3-day option if I think it's going to take 2 weeks to get there, right? But for our purposes here on LRCX, I'm just going to go out a month, okay? I'm going to go out 31 days, and I'm going to change above here. I'm going to change this to Theo Price Mark, and I'm going to click over here, and I'm just going to reset this, okay? And for our purposes today, I'll just use this as an example. I'm going to go up 8% and then go, well, what if the stock drops down 8%? What's it going to do? And what if the stock doesn't move? What are we going to do on this? And the answer is, well, let's see what happens on this. So I'm going to go, first of all, I'm going to go in the money. And so for my judge of being in the money, let me actually do this. I'm going to go quickly to gamma or delta. I'm going to look for something around a 60 delta here. And then for out of the money, I'm going to go for something around a 40 delta. And for at the money, I'm going to go for something around the 50 delta. By the way, for those of you who are newer maybe, if you're wondering where the at the money contract is, of course you can look on here. The at the money contract is the strike price that's closest to the current stock price. Okay? So right now, it's actually technically, it's kind of almost in between, but 99 and 100 there. You could also kind of look at your delta, and your at the money contract is going to be roughly in the 50 delta range. Won't be exact probably, but somewhere in that range there. Okay. So here's what I'm going to do. I'm going to use delta though. I'm going to say 50 delta, 40 delta, 60 delta, or whatever's closest to that. Okay. And I want to just look at the pros and cons of each of those. So if I have a little worksheet here. And so I'm gonna just fill this out. I have out of the money, at the money, in the money, the mark price, the Theo price, if it changes, and the dollar change and the percentage change. Okay. So the out of the money contract, I'm going to go roughly the 60 delta. So the mark price, actually, I'm going to jot down real quickly the strikes we're talking about. We're talking about the 98 strike. We're talking about the 100 strike. And I'm going to look at the 103 strike. Let me just switch this to Theo price. Let's go at the money is going to be, we said, the 100 strike. My mark price is 390. So I'm just going to jot that down on my little spreadsheet. I'll show you the spreadsheet in just it's not a spreadsheet actually, it's a Word doc, but we'll call that a spreadsheet. 390 is the price we're going to pay, and that's just basically going to be the mid price. When you look at the mark price, it's going to show you the mid price essentially, okay? Mid price. And then at the 98, it's 497. And these may move around a little bit on us, but I think we'll get the gist here. So I'm going to go 4.97. And my out of the money contract, we said we're going to do this one, the 103, and that's going to be 269 is our out of the money mark price, 2.69. And just to kind of show you what I'm doing, I just filled in the mark price here on this. Now, if we get that move, let's look up a 5% move higher and see what these would turn out to be, okay? So I'm going to do a 5% higher move here on this. I'm going to click on my Theo price, okay? And I'm going to say, I'm just going to click on this. It gives you a dollar change, but I can just make it a percentage change. Oh, not a 5%, we said 8%. We were going to do 8% because that's how much on this particular stock we were looking at. I'm not going to change the implied volatility, although you can tinker with that if you want. But right now I want to just kind of isolate just stock price move here. And we're going to give it a week here. So instead of the 19th, which is today, I'm going to go to the 26th. And now we're going to look at our values here. Our at the money contract, which is the 100, our value is 863. I'm going to type that in there, okay? 863, 8.63, our out of the money contract, which we said was going to be the 105, is now 642. 6.42 are in the money contract. What do we got? Our in the money contract is 98. We said 1034. Okay. So, and I'm going to show you my document again, 1034. So, which one is best? Okay, this is for the plus 8% move. Okay, plus 8% move. Let's go here. Okay, dollar change. Well, what's the dollar? What's the amount change in my option contract? It's 6.42 minus 2.69. That equals 373. Okay. 3.73. Now, if we were to multiply this by the 100 multiplier for options, that would be $373, not factoring in commissions there, okay? What about the at the money contract? 8.63 minus 3.9. No, I actually could probably do that in my head. 473. 473. And for our in the money contract, 10.34 minus 4.97, I come up with 5.37. Which one do we make the most money on? Okay, which one do we make the most money on? Well, $537. We'd make more money if we go in the money on the contracts. Okay. We make more money if we go get more. If we go out of the money, we make less money. But what about in terms of percentage change? Let's think about it from that standpoint. In terms of percentage change. One sec here. So let me go 6. We'll do the original price. Excuse me, the dollar change is 3.73 divided by 2.69. Is that the best way to do it? That's 138%. 138% gain. 4.73 divided by 3.90 is 121%. 121%. Can you kind of guess what we're going to be at on this one? Let's take a look. 5.37 divided by 4.97 is about 108%. 108%. Okay. All right. So let's draw some conclusions. Well, let's first see what we have. Which one did we make percentage-wise the most? Out of the money. Okay. Out of the money. Now, when I say out of the money, look, there's a lot of contracts that could classify this. So this is from Seriously, okay? Who was asking which out of the money are we referring to? For my purposes, just because I wanted to be kind of consistent on this, I was saying 60 was going to be my in the money contract, 60 delta. 50 delta was going to be my at the money contract. And 40 delta was going to be my out of the money contract. Okay. If we chose a 75 delta, is that in the money? Yeah, that we could have chosen a 75 delta. But I kind of want to just kind of round numbers here to make it easy there on this. But that doesn't matter. Okay, this doesn't matter right now. What matters is, in general, if you do your contracts, if you buy in the money contracts, we're talking long calls, long puts here. If we buy in the money contracts and the stock goes up, you're probably going to see the biggest dollar change if you go in the money, but it's the lowest percentage change. Okay, so we're going to call this out of the money contracts, we're going to call more leveraged. Okay, that's where more leverage occurs on those. Okay, now which ones are going to have the highest time value? Where's theta? Well, typically at the money contracts are going to have the highest time value, time decay, I should say, time decay on those, because they have the most time value too on those. So there's a choice you have when you do these. If you want to be more aggressive, often traders will go, hey, I want to be more aggressive, therefore I'm going to go out of the money on those contracts. And the thing is this, I could buy 2 of these out of the money contracts for approximately, at least, not exactly, but approximately the cost of 1 of these in the money contracts. Yeah, that sounds good. But you got to, so you can go, well, look, I can do that. I can leverage up my returns and actually make the dollar percentage greater than on this. But the key is, remember, this is a bigger percentage change. Okay. Now, I'm going to flip the script here just a little bit on this. And let's do the same thing. And I'm going to do the same contracts, but I'm going to do, I'm going to go, what if the stock goes down on me? Okay. And I'll go down an equal amount. So I'm going to change this. I'm going to keep my date the same, about a week. I'm going to say minus 7%. Minus 7% on that. Now, let me just bring up my doc on the other page. I'm going to bring it up on the other page here. We're going to go to the $100 strike, and we're going to look at the call. And what's our call value, our new Theo price? 0.75. Okay. New Theo price, 0.75. 0.75. Out of the money, we said 103. New Theo price, 0.36. Out of the money, 0.36. And our in the money contract is going to be 1.16. 1.16. Okay, let's do the same thing, dollar and percentage here on these, and see if what results we come up with on this. So let's do it here. Okay. Mark price 2.69 minus 0.36 Theo price. Our dollar change is, I'm going to put it in parentheses because it's a loss, 2.33. Okay. At the money contract, 3.90 minus 0.75 is going to be 3.15 loss. Dollar change for the in the money contract, 4.97 minus 1.16, I come up with a loss of 3.81. Okay, so here we go. Let's go and just do the percentage change thing again here. So I'm going to take my percentage change, 2.33, divided by my initial price, 2.69 equals, that's an 86. I'll do parentheses. 86% loss on this. On this one, 3.15 divided by 3.90 is about an 80% loss on this one. And I've got one more. And then I want to look at some trades there. And I've got 3.81 divided by 4.97. I've got about a 76% loss. Okay, so let's look at our conclusions here and draw some final conclusions on choosing strike prices. What is the biggest dollar loser if things go against us? Ooh, in the money. If you go in the money, you're risking the most money on that. Okay. If you go out of the money, there's just less you can lose, right? We lost more on the in-money contract than the entire cost or theoretical loss of the out of the money contract there. But percentage-wise, we're losing the most on the out of the money contracts. We're losing the most on those out of the money contracts. Again, these are more leveraged. Is leverage good or bad? Yeah, I don't know. Yes, it is good and bad. If things are going your direction, leverage is great. If they're not going your direction, leverage is not great. You don't know which way the trade is going to do, so you need to balance it out as a trader and think reasonably what the odds are on your trade there on that. So in general, you'll notice in this webcast, more often than not, I'm going a little bit in, my examples, we're using a little bit in the money. We're taking what I would consider to be a little bit more of a conservative approach on that. Now, having said that, the little bit more of a conservative approach, I'm actually risking more on a one contract basis. But on a dollar for dollar basis, let's say we decide to invest $1,000 in these out of the money contracts versus $1,000 in these in the money contracts, then we're risking more on this, but we're also giving up more. If you are more bullish on a trade and you want to be more speculative on the trade, maybe you go out of the money. Okay, maybe you go out of the money. Now realize you would not, let's be smart about this. Don't load up your portfolio on, like you're probably not going to load up your entire portfolio on options anyway. It's generally used, the options are generally used for these speculative purposes, which is what we're talking about today, as a smaller part of an overall portfolio. Okay, now let me just go and see if I have any questions. I know Connie's been answering questions. Thank you, Connie, on that. And then we'll go and we'll look at some trades here. Okay, so does that mean option contracts don't have intrinsic time value? So yeah. Questions on extrinsic value. Which ones have the most extrinsic value? Okay, I kind of mentioned that. I called it time value, but it's extrinsic value. Generally, extrinsic value, the at the money contracts are going to have the most extrinsic value. Okay? In terms of total amount. Out of the money contracts, there's no intrinsic value. They still do have some extrinsic value as well. In the money contracts have both intrinsic and extrinsic value on that. Okay, so there you go. And if you guys like forget this, you can go up here, and I think you can go right here and you can look how much extrinsic value. Well, how much intrinsic value do these out of the money contracts have? None right there. You can just change your headers on this intrinsic value. How much extrinsic? Well, you can see these guys are the ones with the most extrinsic value. That means they're going to be most susceptible to time decay. Also, by the way, they're also going to be, let me just add a column here to a Vega column. Notice this. At the money contracts are typically going to have about the highest Vega as well. If I did a theta column, you'd see the same thing. Highest rates are going to be the ones with the most extrinsic value because Vega and theta only they only affect the extrinsic value on the option there. Okay? All right, let's move forward. Let's take a look. Let's go back to our trade here. Our thesis is we're bullish on this. Okay, maybe it goes bullish, maybe it doesn't, but that's what we're going to go with. We're going to say, in general, we've been doing pretty well. Maybe maybe we're bouncing off that 50-day moving average, okay? Maybe we're bouncing off that 50-day moving average, and that's going to be our goal here on this. And so, I'm just going to take our kind of standard approach on this. I'm going to say if we break down below our 50-day moving average, which right now is right around 97.5. Okay. If we break below that, we're going to look to get out of the trade. Okay. I'll give it a little wiggle room. I'm going to let it go a little bit below. But if we say get down to 96.5, we're out of this trade. 96.5, we're going to look to get out of this trade here. So let's go to our trade. What contract am I going to do? Remember, if I want kind of, let me go back to my delta here. Delta tells us how much the option is going to move approximately in relationship to a $1 move in the stock price. But it's also given us that idea on kind of leverage, aggressiveness on the trade. Okay. And so what I'm going to do here is this. I'm going to go in the money a little bit. I'm going to go to that 60 delta. That's what often we'll do in this webcast. If I wanted to be very speculative on this, maybe I'd go out of the money to one of these. Double check your liquidity on these. Double check your bid-ask spread. You can look at your open interest on these. But all of these seem reasonable on this. It's a 15-cent spread on a $5 option, not ridiculously big spread. That's fine on that. So I'm going to right-click on my call. And, where was our target going to be? Were we going to do a target? Yeah, I was going to do a target here. I was going to do my target right up here, right at, we'll say 107.5. I'm not going to make it reach the very high. That was like the high, 108.02. If we get close, 107.5, we're going to call that good. Okay, so here we go. I'm going to my 60 delta. I'm going to right click on this. I'm going to buy custom with an OCO bracket. I'm going to make these good till canceled, good till canceled. I have a limit order. Limit is my target price. Okay, I can do that based on the option price, or I could do it based on the stock price. I mentioned we were going to do it based on the stock price. So in this case, I'm actually not going to, I'm going to make this a market order. I'm going to make this a market order while we're at it too. And we're going to say, if this stock goes up to 107.5, I'm going to click on the gear. I'm going to go, click on that, greater than or equal to 107.5. This is a swing trade. We'll talk about that in one sec. 107.5. And we're going to get out, click on the gear, if we go below 96.50. 96.50. Marks less than or equal to 96.50. Okay, put that in, click save, and we can up the number. Let's click on this for a second, just look. Max loss. Now, that max loss, notice where we're getting that max loss from. That's the cost of the contract. That's the cost of the initial trade. This is not assuming we're stopping out right when the stock hits 96.50, because we don't know when we're going to get out exactly. All right. But there we go. I'm gonna, oh, I don't have any groups out there right now. So I'm just going to click on send, and we're going to send that trade. So there's that trade. Now, when we look at the stock, I said swing trade. What do I mean by swing trade? What I mean is I'm getting out. I'm just looking for this to go like that. Okay. That's all I'm doing. I'm looking for this to swing up. Not as big as that swing was, just this much here. And yeah, it's a speculative trade because look, there's a good chance it's not going to go up that much. But this is not a long-term trade, which is why I'm putting target prices in. If I'm doing a longer-term trade, there's a good chance we're not even going to put in a target price on that. Okay. So there we go. So there we go. That's LRCX. Let's look at another example. Let's look at maybe something on the bearish side of things. All right, market goes up, market goes down. If you want, you can trade either side of the market with these long contracts. Let me go to CMG, Chipotle, Mexican Grill. Okay, I'm taking a more of a bearish approach on this. Number one, we've been going down. Appears to maybe, from a technical standpoint, bouncing off that 20-day moving average. This is actually a close below the low of the high day. And I'm going to go down here. I'm going to go to where my previous low was. Previous low was 41.18. Okay, let me just jot that down. Let's say 41.20. Okay. So I'm going to go a little bit more speculative on this. I'm going to go a little bit more leveraged on this. We don't have as far to go on this. I mean, the stock's at 43.05. We're only going down to 41.20. So that's almost like less than a $2 move on this. So I'm going to leverage this up a little bit on this trade. How am I going to leverage it up? Here's how I'm going to leverage it up. I'm going to, again, I'll stick with 31 days to expiration. That's fine. But I'm going to go to a delta that is a little bit out of the money on this, a 42.50 delta. Our target was 41.20. So we would go below this. And if I want to look at this, I can always go, well, what if, let's see, which strike are we looking at? We're looking at the 42.50. Let's switch to our Theo price. And we said, what if the stock goes down to 41.20? So let me make this a dollar value. And that's going to be about $1.85, I think. Is that right? I did that. Oh, that's a I need a negative sign, not a, you can put negative signs on there, right? There's a 41.20. That's close enough. 41.21. Okay. Let's take a look. See what this would potentially look at. Looking at this 42.50 strike, we're looking at going from, we'll look at the mark price, 114 up to 194. Percentage-wise, that's a pretty significant gain, right? Because we're talking dollar-wise, less than a $2 move on a $40 stock. That's less than a 5% move on the stock. In this case, we're looking at, I don't know the exact percentage that works out to be, but that's close to a 50% gain on the option if it goes where we want it to go. Okay? Now, so here's what I'm going to do. I'm going to do this similarly, but in this case, I'm going to put a stop just based on the option price as well, not the stock price. Okay, I'm going to put a target based on the stock price. I'm going to put an exit, a stop based on the option price. You can do that. I'm going to right-click on this. I'm going to buy custom with an OCO bracket. Okay, these are going to be good till canceled. Try that again. Buy custom with OCO bracket. That is going to be good till canceled. This is going to be good till canceled. Limit price. Well, we said we were going to put that based on the stock price. And that we were just going to say our target was going to be 41.20. So I'm going to go gear, CMG, marks less than or equal to 41.20. All right, we're going to save that. Stop. What's our stop? I'm going to put our stop in at 50%. Okay, stop in at 50%. We're buying this for $1.16. Half of $1.16. Well, half of $1.20 would be 60, right? So it's going to be 58 cents is going to be our stop price on this. Does it guarantee us we're going to get out exactly at 58? It does not guarantee us it's going to get out at exactly at 58. Okay, but those are good till canceled. We've got a trade, and that's what we got. And then let me do this. I'm going to just up my contracts. Now, this is a first triggers OCO order. What that means is we're buying two puts, two contracts, two put contracts, okay? If the stock goes, I messed up on that. Hold on one quick sec. This shouldn't be a limit price. This should have been a market price. Okay. Now we still have those same rules, I think. Yeah, rules of stock in there. Okay. This is an OCO order. We're buying this contract. These sell orders aren't even going to come into play. They're not even going to be active until the initial trade fills. Once that initial trade fills, I have two separate orders to exit out of those two contracts. One, if the stock hits 41.20 or less, okay, it's 41.20 or less. That is this one right here. This one right here. And I also have one in case the option, which we're buying for approximately 116, goes to 58 cents. Again, that's not a guaranteed price, but that is going to get us out if things go against us. Why would things go against us? Well, time decay would work against us, but to get that big a move, probably what it means is the stock is going up because this is a bearish trade. Remember that. Okay, so there we go. I'm going to confirm and send this order. And actually, before I confirm and send that, let me just mention this. Right now, this is saying I'm buying this for 116. Well, that's above what the natural price is. And so that'll probably fill right away. Depending on how the market moves when you do this, if the market is moving around, it's possible this will drift down to something like this, in which case it's not going to fill right away. So you can always tweak this to something closer to the natural price or between the natural price and the mid price. Right now, there's only a penny difference between the natural price and the mid price, okay? So not a big difference there on that. I'm going to confirm and send, and I'm going to send that order, okay? So we filled on that one as well. So there's a put example. Now, I don't have enough time to go through another example here, but I want to just show you some other possibilities here and not go through the whole math calculation or anything there, but just ones that, hey, if you wanted to practice these, and these aren't recommendations, these are these are possible paper trades here for you to check out. But let's think of like this for a bullish trade. Look at Kraft Heinz, okay? I don't know. You can make a bearish case. You can make I think more of a neutral case on this. The trend that we had on this one was broken before. It's gone up, but now we have a lower high. Little bit of a harami right now on this. So I don't know. Is this support level? The 50-day moving average going to hold? Maybe. You can look at a potential possibility on that one there. Let's look at NC. This is Norwegian. The trend's looking a little stronger on this one. Where would our target be? Well, there's different ways to do targets, but often looking at prior highs can be a target, or you can even go to the high of the body of the candle and not the high of the whole candle, just the body of that candle as a potential target. Let's look at another possibility here. This one would be more on the bearish side of things. FCX, okay? Looks like it's rolling over. Looks like we've created lower highs on this trade, and looks like we're bouncing. We got a close below the low of the high day yesterday on that, and that bearish momentum is continuing on that. So could we do a bearish put trade on that? We could. Remember though, as you're doing these, you have a choice. In this webcast, more often than not, we're probably going in the money on these. This is going to be the slightly less leveraged version of the trade. You can go at the money, which is the strike price, which is closest to the current stock price, or you can go out of the money. If you're going out of the money, that's going to be a little bit more leverage on the trade. And we're going to reserve that for more speculative types. These are all speculative option trades, right? These are all speculative, but the more speculative ones are probably those out of the money contracts. It may be more appropriate if you see one that there just isn't, your target is closer and the dollar value of the stock move is less, so you're trying to get a little bit more bang for your buck there in terms of that. But remember, leverage can go for you or leverage can go against you. Now, as I'm wrapping up here, everybody, let me just mention this. You can follow us on Trader Talks channel. A lot of you are watching right now. You went to Trader Talks to get this webcast. But if you don't want to miss our webcasts, Trader Talks is the channel to go to. And you can see Connie's webcasts. By the way, she teaches a great trading ETFs webcast, 4 o'clock Mondays. Those are not recorded, so make sure you check that out live. Or future webcasts here as well. Just make sure you subscribe to that. So everybody, I appreciate you joining me today. Have a wonderful rest of the day. Coming up next, we have Getting Started with Technical Analysis. Barb Armstrong is back. She's teaching that, I think, today. So everybody, thanks for joining me, and we'll see you all same time next week. Bye-bye.